$51 silver in China, the arbitrage that will break the COMEX. The financial world is currently sleepwalking toward a cliff edge that most investors refuse to acknowledge. But the data pouring out of the Asian markets this week is the loudest wake-up call I have seen in 2 decades of trading. We are witnessing a statistical anomaly in the Shanghai silver market that is not just a blip on the radar, but a screaming siren indicating the structural integrity of the global derivatives market is fracturing right before our eyes. The mainstream financial media will tell you to look at the stock market highs or the employment numbers, but those are lagging indicators designed to keep the retail investor docile while the smart money exits the building. The real story, the one that determines the future of your purchasing power, is happening in the physical vaults of the Shanghai Futures Exchange, where the inventory levels have just collapsed to a terrifying new low. To understand the gravity of what is unfolding in China, we must first strip away the illusions of the paper market and look at the raw, undeniable arithmetic of supply and demand that is currently cornering the central planners. The Shanghai Futures Exchange, a critical hub for physical delivery in the East, has seen its silver vaults depleted to approximately 519,000 kilograms, which translates to roughly 16 million ounces of physical metal remaining. To the uninitiated, 16 million ounces might sound like a substantial stockpile, but in the context of the global commodities market, this is essentially the fumes in the gas tank of a jumbo jet mid-flight. This represents a mere fraction of what is required to keep the industrial engines of the world's second-largest economy running, and it signals a desperate scramble for physical possession that Let's put this into a perspective that every serious investor needs to internalize immediately. The total Chinese stockpile, including the Shanghai Gold Exchange, is now estimated to be hovering around 25 million ounces. When you juxtapose that number against the annual global mine production of roughly 830 million ounces, you realize that the entire Chinese accessible inventory is barely 3% of the world's yearly output. We are talking about the manufacturing hub of the planet, the voracious engine of global industry, operating on a razor-thin margin of safety that is evaporating by the day. This is not a market in equilibrium. This is a market that is being drained of its lifeblood by a level of physical demand that the paper markets in London and New York can no longer mask with their sophisticated leasing schemes and rehypothecation games. The implications of this inventory collapse are terrifying when you calculate the days of coverage left in the system, a metric that logistics managers lose sleep over but Wall Street analysts conveniently ignore. The current stockpiles in China represent somewhere between 13 to 15 days of global industrial silver demand, based on the daily consumption rate of 1.6 million ounces. Think about that for a moment. If the mining supply were to hiccup, or if a geopolitical event were to freeze logistics for just 2 weeks, the cupboards in the East would be completely bare. This is the definition of a supply shock waiting to happen, and it is precisely the kind of asymmetric risk setup that creates millionaires out of those holding physical metal and destroys the portfolios of those holding paper promises. We are seeing a bifurcation in the global silver market that is reminiscent of the classic Gresham's Law scenarios where good money is hoarded and bad money is circulated until the system breaks. While the inventory situation in London has eased slightly, providing a false sense of security to Western observers, the squeeze in China is tightening like a noose around the neck of the short sellers. This divergence has created a persistent premium in the Shanghai market, where the price of silver has been closing significantly higher than the spot price in the United States for months. This is not an arbitrage opportunity that will simply close itself. It is a structural defect signaling that the East does not trust the West's paper price and is willing to pay a premium to secure the actual metal. The price action we witnessed this past week is the market's way of telling us that the dam is about to break, regardless of what the Federal Reserve or the bullion banks want us to believe. We saw silver maintain a price above $50 an ounce in the ask price every single day of the week, a psychological and technical barrier that has frustrated bulls for decades. This is a cause for celebration for those of us who have held the line, but it is also a warning shot that the volatility ahead will be unlike anything we have experienced in our lifetimes. When an asset class that has been suppressed for 40 years suddenly breaks its chains and holds the high ground, it is usually the precursor to a chaotic repricing event that catches the majority of the investment public completely off guard. We must analyze the specific closing numbers from the Asian session, because they reveal the desperation of the buyers who are scrambling to secure delivery before the vaults run dry. On November 21st, the closing price in China was $51.17, a staggering premium over the Western spot prices and a clear indication of backwardation in the East. Backwardation is a term that makes bankers sweat because it means the cash price for immediate delivery is higher than the futures price, proving that the market values a bird in the hand far more than two in the bush. This condition only arises when there is a genuine, acute shortage of the physical commodity, and it is the market's way of screaming that the warehouses are empty and the emperor has no clothes. Meanwhile, here in the United States, we are seeing a bizarre and temporary return to contango, where the futures price is slightly higher than the spot price, suggesting adequate supply in the COMEX vaults. The COMEX futures price was hovering around $50.33, while the bid price was slightly lower, creating an illusion of normalcy that stands in stark contrast to the panic in Shanghai. This disconnect between the COMEX and the Shanghai Futures Exchange is the financial equivalent of the tide going out before a tsunami. The water looks calm on our shores, but a massive wave of demand is building on the other side of the ocean that will eventually crash into our markets and wash away the paper price suppression mechanisms. The silver squeeze, too, is not just a catchy hashtag for retail investors on social media. It is a quantifiable phenomenon happening in the dark corners of the institutional vaulting networks. We are witnessing a run on the vaults of the major precious metals houses, particularly within the London Bullion Market Association and the Shanghai exchanges. The smart money knows that the registered inventory, the metal that is actually available for delivery, is dwindling rapidly, and they are positioning themselves to be the ones holding the chair when the music stops. This is a game of musical chairs where the stakes are the survival of the fiat currency system, and right now, the music is playing faster and louder than ever before. Rumors have been circulating that China might shut down the exporting of silver out of their vaults entirely, a move that would essentially weaponize the commodity and send shockwaves through the global technology sector. While these rumors have not yet been officially substantiated, the very fact that they are being whispered in trading pits suggests that the insiders are bracing for a protectionist move. If China, the world's factory, decides that silver is a strategic national security asset, which it absolutely is, and locks down its borders to outflows, the global price of silver will not just rise. It will teleport to levels that will make $50 look cheap. The depletion of the Shanghai vaults to a new low is not just a data point. It is a historic event that marks the transition from an era of abundance to an era of scarcity. According to reports from Oriental Ghost, this level of 519,000 kilograms is uncharted territory. A fresh new low that confirms the trend of relentless drainage is accelerating rather than slowing down. We are entering a phase where the buffer stocks that allowed central banks to manipulate prices are gone, leaving the market exposed to the raw forces of supply and demand. When you remove the shock absorbers from a vehicle moving at high speed, every bump in the road becomes a potential crash, and the silver market is currently hitting a very rough patch of pavement. The demand for silver is not merely a speculative frenzy. It is driven by the unyielding laws of physics and the requirements of the green energy transition that the Western governments are forcing upon the world. Every solar panel, every electric vehicle, every cruise missile, and every smartphone requires silver to function, and there is no substitute for its conductivity. The Chinese economy is pivoting aggressively toward high-tech manufacturing and renewable energy, which means their appetite for silver is insatiable and non-negotiable. They are not buying silver to flip it for a quick profit in fiat currency. They are buying it to consume it, which means that metal is leaving the vaults and vanishing into landfills or industrial products, never to return to the market at these price levels. We must also consider the broader geopolitical context of what is happening with the BRICS nations and their systematic rejection of the United States dollar as the reserve currency of the world. China is leading the charge in accumulating real assets, gold, silver, oil, copper, while divesting from U.S. Treasury bonds, effectively trading paper promises for tangible. The drain on the Shanghai silver vaults is part of this larger strategy to secure the resources necessary for a post-dollar world. They know that when the sovereign debt crisis inevitably hits the West, the nation with the most gold and silver will dictate the terms of the new monetary order, while the nations holding paper debt will be left holding the bag. The fact that the price of silver has risen by over 3% in a single trading session in China, despite the inventory bleed, creates a devastating 1-2 punch for the short sellers who are trying to keep a lid on the price. Usually higher prices would dampen demand and allow inventories to rebuild, but we are seeing the opposite occur. Prices are rising, and inventories are still falling. This is the classic signature of a jiffin goods scenario or a panic buying event, where rising prices actually stimulate more demand because buyers fear that if they don't buy now, they will never be able to buy at all. This psychological shift from buying the dip to buying the rip is what fuels hypercompounding bull markets that destroy the bears. The cushion that the Western markets think they have, thanks to the relative stability of the COMEX inventories, is a dangerous illusion that will shatter the moment the arbitrage window becomes too profitable to ignore. If silver is trading for $51 in Shanghai and $50 in New York, sophisticated traders will inevitably buy every ounce they can in New York to ship it to Shanghai. This flow of metal from west to east is a gravitational force that will eventually equalize the prices, likely by dragging the US price up to meet the Chinese reality. The COMEX is bleeding silver to London, and London is bleeding silver to China. It is a one-way street leading directly to the industrial furnaces of the East. We are also seeing signs that the London Bullion Market Association, the heart of the global pricing mechanism, is struggling to meet the delivery demands of its Eastern counterpart. The speculation that the LBMA is not delivering to China because they need the silver themselves is a polite way of saying that the cupboard is bare in London as well. When the primary hubs of global liquidity start hoarding metal and refusing to settle international flows, it signals a breakdown in trust and a return to a beggar-thy-neighbor policy environment. This is exactly how currency wars turn into trade wars, and eventually into kinetic conflicts over resources. The COMEX data shows that while we are technically in contango, the margins are razor-thin, and the situation could flip to backwardation in a heartbeat if a major entity stands for delivery. The fact that we are not in deep contango despite the high prices suggests that the market is wary of future supply availability. The cushion of $5 or $6 to the downside that technical analysts might point to is irrelevant in the face of a physical shortage. Support levels on a chart mean nothing when a factory in Shenzhen needs 10 tons of silver to keep the assembly line moving, and there is zero metal available at the spot price. The input from the PM bug community and the discussions on platforms like X highlight a growing awareness among retail investors that the divergence between gold and silver performance is a temporary anomaly. While gold has remained relatively on par with the LBMA spot price, silver's premium in China suggests that silver is the asset under the most acute stress. This is likely because gold is primarily a monetary asset stored in vaults, whereas silver is an industrial necessity that is consumed and destroyed. The industrial user cannot wait for the price to come down. They must pay the market rate or shut down their business, which makes the price of silver far more explosive in a shortage scenario. It is fascinating and deeply concerning to watch the ask price in the United States climb to $50.60, dragging the entire complex higher despite the apathy of the mainstream financial press. This quiet grind higher is the most bullish action possible, because it indicates steady, relentless accumulation rather than a speculative blow-off top. The smart money is not making noise. They are simply hitting the buy button every time the price dips, absorbing the float and tightening the screws on the bullion banks. This is a war of attrition, and the physical buyers are winning because they have time and mathematics on their side. The sheer volume of silver exiting the Shanghai vaults, nearly 17 million ounces remaining against a backdrop of billions of ounces of paper trading, exposes the fraudulent nature of the fractional reserve commodity system. For every ounce of physical silver in the vault, there are likely hundreds of paper claims floating around the derivatives market. As the physical inventory approaches zero, the game of musical chairs must end, and the holders of paper contracts will be forced to settle for cash at a price dictated by the exchange, missing out on the explosive revaluation of the real metal. This is the moment of force majeure that we have been warning about for years. We must also consider the broader economic environment in the US, the macro problem that serves as the backdrop for this silver drama. The Federal Reserve is trapped in a debt spiral of its own making, with interest payments on the national debt now exceeding the defense budget. They cannot raise rates to fight inflation without bankrupting the government, and they cannot lower rates without sending inflation to the moon. In this environment, hard assets like silver are not just investments. They are insurance policies against the inevitable devaluation of the currency. The Chinese know this, which is why they are converting their trade surpluses into metal, while American investors are still chasing tech stocks priced at 50 times earnings. The looming rate cut in December, which is being whispered about in the corridors of power, will act as rocket fuel for this already combustible situation. If the Fed pivots and starts cutting rates while inflation is still running hot, real interest rates will plunge deeper into negative territory, making non-yielding assets like gold and silver infinitely more attractive. A rate cut would be an admission of defeat, a signal that the Fed has chosen to sacrifice the dollar to save the bond market. When that signal is flashed, the rush into precious metals will not be a trickle. It will be a tsunami that overwhelms the physical supply chain completely. The silence from the mainstream media regarding the Shanghai vault collapse is deafening but entirely predictable. They are programmed to maintain confidence in the fiat system, and reporting on a run on silver would undermine that narrative. However, the absence of headlines does not mean the absence of risk. It simply means that the opportunity to position yourself ahead of the crowd is still open, albeit closing fast. By the time CNBC and Bloomberg are running 24-hour coverage on the silver crisis, the price will likely be double or triple what it is today, and the physical metal will be unobtainable at any price. We are looking at a potential tipping point, where the divergence between the East and West breaks the pricing mechanism entirely. If the Shanghai price continues to pull away from the COMEX price, arbitrageurs will strip the COMEX bare, forcing the US exchange to either default or let the price rise to meet the Chinese reality. This would result in a sudden, violent gap-up in prices overnight, leaving anyone waiting for a pullback completely left behind. The cushion mentioned in the data is not a safety net. It is a launch pad. The unknown variable in this equation is the destination of the silver leaving the vaults. Is it going to the People's Bank of China to bolster their reserves? Is it going to the solar panel gigafactories? Is it going into private hoards of wealthy Chinese citizens fleeing the yuan? The answer is likely all of the above, which makes the demand structural and insensitive to price. Unlike speculative demand, which flees when prices drop, strategic demand accelerates when prices drop, creating a floor beneath the market that is made of concrete reinforced with steel. Let's address the collapse scenario mentioned in the reports. While a total collapse of the exchange is a tail risk, the more likely outcome is a failure to deliver event that bifurcates the market into a paper price and a physical price. In this scenario, the screen price might say $50, but if you want a 1,000-ounce bar delivered to your driveway, the premium might be 100%. This is what happened in the nickel market, and it is what happens in every currency crisis in history. The official rate becomes a fiction, and the black market or physical rate becomes the true measure of value. The fact that Oriental Ghost reported these numbers on a weekend, before the markets opened, adds a layer of urgency to the analysis. These fluid situations often resolve themselves violently at the Sunday night open when liquidity is low. The traders in Asia open their books while New York is sleeping, and by the time Wall Street wakes up, the game has already changed. This is why holding physical metal in your own possession is the only way to sleep soundly. You are not dependent on the operating hours or the solvency of a futures exchange on the other side of the world. For the American investor, this data from China is the canary in the coal mine that has not just stopped singing but has dropped dead off its perch. The depletion of silver inventories is a leading indicator of a much larger shift in global capital flows away from financial assets and toward hard resources. The era of financialization, where we could print prosperity, is ending. The era of resource nationalism, where he who holds the gold and silver makes the rules, is beginning. The Chinese are positioning themselves for this new reality. The question is, are you? The cushion of support that the analyst suggests, $5 or $6 to the downside, is likely the maximum risk you face in holding silver right now, whereas the upside potential is practically uncapped. If the vaults hit zero, price discovery takes over, and in a world drowning in quadrillions of dollars of derivatives, the price of the tiny sliver of physical silver available could go parabolic. The risk-reward ratio of this trade is arguably the best in the entire financial landscape, provided you have the patience to wait out the manipulation and the volatility. Do not be lulled into complacency by the fact that the US market is in contango. This is a temporary aberration caused by logistics and the calm before the storm. The pressure building in Shanghai will eventually blow the lid off the COMEX. The arbitrage is too juicy, the demand is too real, and the supply is too finite. Physics always wins in the end. You cannot print silver. You cannot quantitative ease a silver shortage. You have to dig it out of the ground, and right now, we are digging it out much slower than we are using it. So what is the takeaway for the individual looking to protect their wealth? It is simple: become your own central bank. The data from Shanghai proves that the big boys are taking delivery. They are removing the counterparty risk. They are exchanging digital credits for cold, hard metal. If the entities with the most information are draining the vaults, you should be doing the exact same thing on your own scale. Secure your position in physical gold and silver now, while the paper price still reflects a reality that no longer exists. The window of opportunity to acquire silver at these levels is closing. When the shortage becomes public knowledge, the premiums will explode, and the availability will vanish. We are watching a slow-motion train wreck of the fiat pricing model, and the only lifeboats available are made of gold and silver. The collapse of the Shanghai vaults is the signal you have been waiting for. Do not ignore it. History will not look kindly on those who saw the floodwaters rising and chose to stay in the house, because the weatherman on TV said it was sunny. This is not about getting rich quick. This is about survival and wealth preservation in a time of monetary regime change. The dollar is dying a death by 1,000 cuts, and the silver market is one of the vital arteries bleeding out. The East is preparing for the funeral of the dollar by stacking real assets. The West is still in denial. Choose which side of history you want to be on. Get physical, get liquid, and get prepared. The storm is not coming. It is already here, battering the shores of Shanghai, and it is heading west at breakneck speed.